financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. My name is Jerry Robinson, as you just heard, and I have been helping people just like you understand money for many, many years. Coaching here at followthemoney.com for many years as well. And what we focus on really is all about finances and financial liberty. How do you break free financially? How can you create multiple streams of income? These are the kinds of questions that we like to tackle here at Follow the Money. And today, we're going to be moving ahead again with another very important topic. This time, the title of today's podcast, 7 Ways to Grow Your 401k. 7 ways to grow your 401k. Very powerful strategies that I want to share with you here regarding the 401k. Well, let's just begin with what a 401k is before we get any further. So what is the 401k? It's an employer-sponsored retirement savings plan that lets employees contribute part of their salary into this long-term investment vehicle. And they can do that through regular paycheck deductions, automatically taken out of your paycheck each and every paycheck period, goes into your 401k account. And the 401k, by the way, was actually started back with the Revenue Act of 1978. It actually created a Section 401k. That's where we get the name. It's a Section 401k in the Internal Revenue Code. And what that did was it actually allowed employees a way of avoiding taxes on deferred compensation. And when we think about the 401k, we realize that it's a relatively new invention. As we mentioned, it didn't really come around until the late 70s. And then, of course, by the 1980s and 90s, it was really being adopted aggressively. But why was it adopted so aggressively? Well, many companies used to provide defined benefit plans like pensions. And these were, as the name suggests, a defined benefit. So the company would, give you a defined benefit, a defined amount for your whole life. And these pensions, as they're known, these pension plans, defined benefit pensions, which had payouts for life, were very, very good kinds of plans for the employee who had spent their whole life working for a company. Well, today, 401ks are not these defined benefit pension plans, but instead they're known as defined contribution plans. They're still very powerful tools. They're just certainly less reliable than the defined benefit pensions, which used to provide those payouts for life. And, in the case of a defined benefit plan like a pension, that actually tells you how much retirement income that you're going to receive as an employee once you retire. That's a really nice benefit. Well, the defined contribution plan, such as a 401k, doesn't tell you how much you're going to have in the end. It just simply specifies what the employer and the employee will contribute to the employee's retirement account over time. Now, before we get too far into the topic of 401ks, you should know that there's 2 types of 401ks. We'll discuss a bit more in detail later in this segment. You obviously have the traditional 401k, which your contributions are tax deductible, and those contributions are tax deferred until you begin taking distributions at retirement. At that time, you begin paying ordinary income taxes on each withdrawal. Now, there's also a Roth version. You've probably heard of the Roth IRA. There's also a Roth 401k. And the Roth 401k, which we'll talk about a bit more in depth in a few minutes, is where employee contributions are made with after-tax dollars. Means there's no immediate tax deduction for the employee when he actually makes the contribution, but he is able to take that money out at the time of retirement. He's able to withdraw it in a tax-free manner all things being equal. So that is certainly an important distinction between these two types of 401ks that we're going to talk about in our 7 ways to grow your 401k. Now, before we get any further, also, I want to address those of you who may be listening and saying, well, I have a 403b, Jerry. So is that similar? Are these ways going to help me with my 403b? Well, the answer is yes, mostly, because 403bs are very similar to 401ks. But they're usually or typically intended for employees of nonprofits. Think of religious organizations, churches, other tax-exempt organizations, maybe even political groups that qualify, or even public schools. Public schools are a real common place where employees have a 403b as opposed to a 401k. The 403b has less requirements. They're not nearly as burdensome on the administrative side. This is largely due to the fact that many nonprofits don't have the same kind of cash flow or capital and manpower even that the for-profit sector does. But also the 403b tends to offer you more lenient requirements for early withdrawals before retirement. But the 401k typically provides more options when it comes to investing. So you typically have more options, not always, but sometimes. So anyway, many, but not all of the ideas that I'll share in this episode are likely to apply to both the 401k and the 403b just at the outset. And again, I want to stress that the 401k is an employer-sponsored plan. It is not an IRA, which the IRA is an individual retirement account that you can set up on your own. You don't need a company to do that for you. That's not a company plan. It's an individual plan. But the 401k, of course, is this company-sponsored plan that can really be meaningful to your overall retirement and investment assets as you grow your financial plan. So with all that said, let's dive in and discuss these 7 ways to grow your 401k. All right, so let's begin with strategy number 1 for growing your 401k, and that is to contribute up to your company's match. Now, a 401k match is the money that your employer is going to contribute to your 401k. So every dollar that you save in your 401k, your employer has the option of matching your contribution up to a certain percentage of your salary. So whenever I used to work in the corporate world, I had a 401k that the employer matched dollar for dollar up to 6% of my contributions. After that, it was just on me. Now, when the employer matches your contribution, you have to realize that this is instant returns. I mean, these are great returns that you should definitely take advantage of if possible. I remember being in the corporate world and having a 401k and going to the HR department. This was early on whenever I was young and kind of just getting out in the corporate world. And the HR department oftentimes didn't have a lot of answers for the questions that I had, and I oftentimes didn't know the right questions to ask. So it kind of made it complicated. But the one thing that most people that I knew at the time at that company, they realized that the 100% match on the first 6% of your salary, that was pretty hard to give up. So most people would, if they knew about it, they would contribute up to the match. But some people didn't know about it. And I think that's the way it is just in general, that oftentimes we may or may not know what our 401k plan at work is offering. And if there is a match, it's almost just guaranteed that is probably the very first place. If you're investing in stocks or mutual funds or ETFs, that's almost the very first place you want to put your investments, because you're automatically going, there's no other place you can go to get that 50 cent or dollar match for every dollar that you put in. Now, your company may not provide a match. It may. And sometimes, I think the most common match today is usually around 50 cents on the dollar, up to about 6% of your salary. That's pretty common today. Some companies are much less generous and offer less. Others are more generous and offer more. Another thing to think about here on this particular way of growing your 401k, it's going to grow your 401k if you're not already contributing up to the company match. But I also want to stress that going beyond the company match may or may not be right for you. So don't feel pressure to max out your 401k before you consider all of your options, including other tax-free retirement savings vehicles. And that brings us, by the way, to the second way that you can grow your 401k, and that is using or considering the Roth option. ROTH, the Roth option. So as many of you know, I'm a big fan of the Roth version of the 401k and the IRA. And this is because the Roth version of these accounts provides an extremely powerful way for you to be able to generate tax-free income in the future. Now, there's trade-offs, of course, but those trade-offs are often worth it over the long term. Of course, everyone's situation is different, so there's no one right answer, for every single person. But let's just say it this way. When you have a traditional 401k, you basically pay your taxes later. You pay them when you begin to withdraw, right? With a Roth 401k, you pay your taxes now, if you will. So in other words, what that looks like is that when you put money into a traditional 401k, you're putting in pre-tax dollars. That is, you pay no income taxes on the contributions that you place into the 401k when it's a traditional 401k. And those investments are going to grow tax deferred, so you don't have to calculate how much money you've made in the 401k this year and report it to your CPA and then have to pay taxes on those gains. Nothing like that in a traditional 401k. And then whenever you begin to withdraw your contributions and the earnings in retirement, that's where you pay your ordinary income tax, is on the withdrawal. So that's the traditional 401k. But the Roth, you make after-tax contributions to your 401k. So you actually pay income tax on your contributions whenever you make them in that same year. And just like the traditional 401k, your investments and everything in it, in that Roth 401k, is going to grow tax deferred, right? So you're going to enjoy that tax deferred growth just like you would in the Roth 401k. The difference is that when you get to the time of withdrawing your contributions in retirement, you will pay no income tax on the withdrawals, right? So some people say, well, I need that tax benefit today. I really would like to have, lower, no taxes on the income when I reach retirement, but I really could use that tax benefit today. Well, like I said before, there's not a right or wrong answer for every single person. This is really depends upon your personal situation. But I would say that if there is a way for you to consider the Roth option, if there is a way for you to make these contributions with after-tax dollars, then you're going to be able to enjoy tax-free income in retirement. And why is that important? Well, if you've ever seen the top marginal tax rates chart, for example, I've often taught with that top marginal tax rate chart when I do teachings. And you'll see that right now, even though it's hard to believe, relatively speaking, taxes are low going back for the last many, many decades. The top marginal tax rate back in the 50s, for example, was around 90%. Okay, much lower today. It's in the 30s. So the point is that can taxes go higher? Yes. And why would taxes go higher? Well, because the government needs more money, right? And so you have to think to yourself, if I'm retiring in 30 years, will the government need more money in 30 years from now, or will they need less money? Are they more likely to raise taxes to cover all of this historic amount of spending and the national debt and the deficits and all their crazy spending that they're doing? Are they going to raise taxes? I think so. And so if you put money into a traditional IRA, what you're doing, into a traditional 401k or an IRA for that matter, if you put your money into a traditional 401k or IRA, you're basically putting it into a black box with no knowledge of what the actual tax rate is going to be. Now, somebody says, well, Jerry, my tax rate will be lower. Obviously. Well, let's not be so sure, right? Again, the government is sitting on top of massive amounts of debt. It's going to have to finance it somehow. And it appears that the top earners, the billionaires and the multimillionaires, have lots of loopholes to be able to get out of paying taxes. So who's going to have to pay it? Well, people who don't have great tax attorneys and people who have lots of money stuffed in what? Stuffed in traditional 401ks and traditional IRAs, because those have not been taxed yet. right? So the government is just waiting to tax those whenever you go to withdraw. And if you were going to be withdrawing 20 or 30 years from now, the tax rate could be much higher. And by the way, if you're aiming for a lower tax rate by retirement, you would probably say you might be doing it wrong, because over time, as you grow your experience and grow your education and grow your knowledge, you would expect that you would be rising in the tax brackets, not going down. So regardless, the Roth option is one of the most powerful strategies, I think, if you're able to make it work. So if you're able to, not have to have that tax deduction in the same year that you make the contribution, if you can forego those, well, your future self, believe me, will be very happy to be receiving that tax-free withdrawal from your Roth 401k. So something to think about. Now, you have to go and ask your company. This would be one of the very first things I would do, is I would go to my HR department and I would ask them, does this company offer a Roth version of the 401k, assuming they offer a 401k at all. Now, the second question that you can ask, and this will be the third way to boost your 401k, would be to ask about a brokerage link. Now, for years, employees who have made 401k contributions, they've long suffered and faced very limited investment options. Again, I can remember when I had a 401k in the corporate world, and I think there were like 10 or 12 mutual funds that I could choose from. And they were good mutual funds overall. I think they were American funds, and there were a few other T. Rowe Price funds. But the point is that they were very few. And I certainly couldn't invest in stocks or other types of single stocks, or except for maybe the company stock. I do remember that they allowed me to invest in the company stock. But many times you can get over invested in your company. You've got all your human capital tied up in that company, and then you're going to put tremendous amounts of financial capital. It might be a little too heavily concentrated. So the point is that with the brokerage link, you're actually able to invest more broadly. So in recent years, we've seen a change with the introduction of the self-directed brokerage account known as BrokerLink or Brokerage Link. It's a brokerage window, basically. It's a self-directed brokerage window that you can connect to your 401k that provides you with more investment choices than a regular 401k offers. So stocks and ETFs and bonds. And you would actually establish this with like an actual broker like E-Trade or Fidelity. And then you would have access not to just those 10 or 12 mutual funds that are in the 401k that you see, whenever you look at the plan itself, but instead you'll have many more options. So you can invest in stocks and ETFs, in certain bonds, and many other things. So ask about if your company offers a broker link or a brokerage link for the 401k that allows you to have, more options for investing. Having more options is good. Having more choices is good. Now, it's not always good if you don't know what you're doing. In other words, if you go out and start, putting all of your 401k money into penny stocks, well, obviously that's not a good way to use the brokerage link. So obviously, if you have a good strategy in place, don't just assume that the brokerage link itself is going to solve all of your problems. In fact, it may complicate your problems if you don't have a sound investment strategy, right? So some people that actually can be harmful to. So keep all that in mind and only do it if you're prepared to do the research and the consequences that come with investing in single stocks and things of that nature. Okay, so there's the first three ways to grow your 401k. Number one, contribute up to your company's match. At least take advantage of that. Consider the Roth option. See if they offer one at your company, and then ask about a brokerage link. Okay, those are the first three ways. Let's move into the fourth way that you can grow your 401k, and that is to focus your investing on high-quality, yielding companies. High-quality, yielding companies. Now, I cannot overstress or overstate the importance of this one. If you go back and you look at the returns of S&P 500 index stocks by their dividend policy, it is simply incredible. Going back to, say, 1973, a $100 put into the market going forward from 1973 all the way to 2021. So that is, almost 50 years, right? So going that far, what you discover is that during that 50-year period, $100 was turned into more than $14,000 if you put it into companies that grew their dividend in the S&P and were constantly growing that dividend. So paying a dividend and growing the dividend, that policy. Whereas if you put that same $100 into a company that was just paying a dividend but not growing it, it would have been about half as much. That $100 would have turned into about $9,000. So that's still great over that 50-year period. But you would rather have $14,000 or $14,500 from the $100 when you invested with dividend growers, right? And it's just simply astonishing when you look at the various types of companies based upon their dividend policy and how they've returned. So again, dividend growers by far are the most powerful types of companies that you can get exposed to for the long term. If you go back and look, say, from 1930 to 2021, that's a long period of time. The dividend income's contribution to the total return of the S&P 500 index was around 40%. So if you weren't invested in dividend-paying companies, 40% of the return that the S&P enjoyed from 1930 to 2021, you would not have enjoyed, because a lot of it, almost half of it, came from dividend income. More than half of it, by the way, came from dividend income in the 1970s, which many people are worried we're going to go through, like a stagflationary time, like the 1970s where we had high inflation and low growth. Well, in those times, dividends become even more important. Say in the 1970s, for example, 73% of the entire return of the 1970s in the S&P 500 came from dividends. So like 3 out of 4, right, dollars came from dividends in that decade. Now, recently, like in the 2010s, for example, only about 17% of the growth came from dividends, because we've had, high growth since that time in the 2010s. But the point is that overall, investing in high quality yielding companies, this is the way to be able to grow your portfolio over time. I mean, you can even just look, for example, this year in 2022, we've had a really tough year for the markets. And if you look at, say, the S&P 500, it's trading down, say, 12 or 13% year to date. But if you look at the S&P 500 high dividend ETF, you'll find out that it's actually in positive territory. So good, strong, high-quality companies paying a strong yield, not too big. Again, you don't want to go for the highest yield. You don't want to get into a yield trap. But you do want to find those high-quality companies that pay a growing dividend. These are often known as dividend aristocrats or dividend kings, and we keep track of those here for our members, and we talk about them regularly. So yeah, that's one of the most powerful strategies that you can employ, buying high-quality yielding assets, and especially when markets are afraid, when the markets turn south, whenever people are concerned. Remember, your 401k is not a savings vehicle for tomorrow. It's a savings vehicle for retirement, which is way down the line for some of you. It may be closer to you than some, for some of you. But the point is that this is a longer-term strategy, so you do want to take advantage of fear whenever it rises, and you can do that by buying those high-quality yielding assets in your 401k, and especially whenever people are scared and prices are falling. That can be a great time for long-term accumulation of those kinds of assets, because, again, that's what the purpose of the 401k is for. Now, if you don't want to save money in stocks, then you really don't need a 401k, right? The 401k is not just to put cash in. It's to grow your money, right? And cash doesn't grow by itself. So you have to put it into something. Now, this brings us, by the way, to the fifth way to grow your 401k, and that's specifically cash. We were just talking about cash. So let's talk about this. The fifth way is to have a cash strategy, okay? So let's break this up into a couple of points. The first point is that when you have a cash strategy, what I mean by this is that you need cash savings outside of your 401k, so you don't end up having to take money out of the 401k down the road during your working life to be able to pay bills. This is what happened to me. Whenever I first got started with my 401k, I was told to stuff it as much as I could, right? Because, hey, I mean, you might as well put all the money you can into the 401k, right? Well, that's not always wisdom. There are many other vehicles that you could put money into, and you may tap all of your, you may only have so much money to put into stocks, And if you put it all into a traditional 401k, well, then every single bit of it is going to be taxed later, right? You don't have any tax-free strategy there. So the point is that it's not always the smartest thing to do to max out your 401k. We've already talked about that. But having a cash strategy means that you have cash savings outside your 401k. So when I got started at my company, my first corporate job, and I started contributing to my 401k, I was told to max it out. So I did. And guess what happened? I needed to buy a house. And I didn't have any money. Why? Because I was maxing out my 401k. And then what am I going to do? How am I going to find the money? Well, I had to borrow the money, right? And then, now I need to put furniture in my house. How am I going to afford that? Oh, well, I guess I got to borrow some more. So in other words, if you stuff all of your available money into the 401k and you don't have a cash strategy outside that 401k, then you're just going to have to borrow from it later, which is not really the most ideal way to do this. So first of all, you need to have a good cushion of cash savings outside of your 401k that you can use for those times of emergency so you don't have to tap your 401k every time you have a problem, right? You don't want to be tapping the Visa or the 401k every time you have a flat tire. It's better to have cash that you can use for those emergencies, especially when the markets are down. This is usually the worst story. These are some of the worst stories, but like back in 2008, whenever everything was crashing, the stock market was crashing and people were losing their jobs, and then foreclosures on houses, and they were behind and they couldn't afford their credit card payments. Where did they go? Well, they went to their 401ks to get some money because they had a big pool of money in there. Some of them did. And when are you taking the money out? You're taking it out at the absolute lows, right? So it's the worst possible thing. One of the worst strategies is to rely upon your 401k to fund your lifestyle, through your working years. That's not what it's for. So try to have a cash strategy where you don't need to get into that 401k every time you need money. And also, one more point about having a cash strategy is that also don't forget that you can make strategic moves to cash within the 401k. So like you may want to have a little bit of cash in the portfolio to take advantage of opportunities. So you may not put all 100% of everything always straight into investments. You might leave like a 10% cash open for cash to take advantage of opportunities, right? Maybe we have a really big sell-off, a black swan event, and you've got some extra cash in there you've been saving for that moment. Well, then you can deploy and get a great cost basis on something. Also, and many people don't know this, and you really should. You should be empowered with your 401k with this knowledge, and you don't want to abuse this, but you certainly can. If you ever are in the situation where you're saying something doesn't feel right, the market is getting very skittish, and I'm getting very close to retirement, and I don't want to lose this money that I've worked hard to save right before, I don't want to have a big market crash right before I retire. Well, you can take some of that money and move it into safer things or straight into cash, right? So you don't have to be invested with 100% of your money in stocks in your 401k all the time. So you can take some of that, sell it, move to cash if you want to. You can do that for opportunities. You can do that to go to the sidelines if you're concerned about something. The point is, though, you don't want to leave it there. So, 401k is not a great cash savings vehicle. It's a terrible cash savings vehicle. It's not what it's for. It's designed to save for retirement. So you don't want to leave it in cash. That would be then basically, why are you even bothering with the 401k? You just go save cash in a savings account. At least you have access to it and you don't have to pay penalties and all this. So the point is that having cash outside the 401k is a very important thing, so you don't have to dip into it. And then using a cash strategy inside the 401k, having some available cash so that you can take advantage of opportunities, and also moving some of your positions to cash if you are very concerned about something. It's your money, so you have the right to do with it what you want, and you may not be able to cash it out and put it in your hand, but you can move out of what you perceive to be risky assets into cash while you're waiting for some situation to resolve where you're concerned about, right? Again, you don't want to be putting all of your money in cash in the 401k. That's the worst possible thing that you can do over the long term. That's not what it's for. But you have the ability to move to cash for brief periods of time without any kind of taxable event because it's a tax-deferred account. So if you want to do that, there's no problem doing that. That's something that you can do. So there's the fifth way to grow your account. Maybe not necessarily growing it per se, but having that cash strategy allows you to preserve it. And I guess having some cash also will allow you to grow it if it allows you to take advantages of opportunities that you wouldn't have otherwise had exposure to. All right, so the sixth way to grow your 401k today on today's podcast is trading. Trading, swing trading and position trading. That's something that we teach here at Follow the Money quite a bit. The idea of swing trading. Now, you can swing trade and position trade within your 401k. Now, if you have a brokerage link, as we were talking about earlier, well, then you can actually swing trade and position trade stocks and ETFs and all of this. But if not, you only have, say, exposure to 10 or 12 mutual funds and then just a few other things as well. Well, you could still even position or swing trade those, right? If you wanted to. Now, this is assuming that you know what you're doing, that you've learned how to trade, that you've learned the skill. And this is a way that you can, supplement the growth of your overall 401k. Now, I want to say this, is that usually what I see successful people do is they'll take 90% of their 401k funds and they will leave them deployed in great high quality companies and assets for the long term. And then they'll take a 10% allocation from their 401k and they'll use that to trade, right? That's a really powerful way. Another sample allocation I've seen is that somebody takes 80% of their 401k money and they keep it in long-term investments. They take another 10% and keep it in cash for opportunities, to add to those long-term investments, and then another 10% for trading. Now, it's really up to you. You're the architect here. You're the one who's designing this. But I would say that you really want to limit the amount of trading that you're doing in the 401k. That's not something, it's not really what it's for. And you really shouldn't be doing probably more than 10% unless you really, really know what you're doing. So yes, develop an allocation for your 401k. And if you do have access to a brokerage link, then trading could be a powerful, powerful way for you to amplify the gains in your 401k. But it can also be a way to lose money, right? So you got to know what you're doing, and this is not for everybody. So if you know how to trade and it's just something you hadn't thought about doing with your 401k, that's an idea for you. But again, if I was doing that, I would limit it to maybe just 10% of my total balance, and I would trade with that. That should be enough to allow you to soup up the overall gains over time, and it should be beneficial. All right. And then finally, we've gone through 6 ways now to grow your 401k. Let's talk about the final and the 7th way here, and that is to stay at the company that you are working for with that 401k until you are fully vested, right? If at all possible. So when I say the word vested, if you're not familiar with what that means, it just means that that part of your 401k that is vested is the part that is yours, that you can keep. Now remember, any money that you contribute to the plan, that's yours always. You're always 100% vested for your own contributions. But I'm talking about the money, if your company does make any kind of matching, well, that's going to be dependent upon the plan's vesting requirements of how long it'll take for you to have access to those before you leave the company. There is graded vesting, which is very common. That's where, like, after year 1, 20% of the company's contributions to your plan will be available to you. After year 2, 40%. After year 3, 60%. And then after 5 years, it's 100% vested. Then there's also cliff vesting. Cliff vesting is where you're pretty much 0% vested, or maybe like 10% vested, until a certain time requirement is reached. And then suddenly, just all of a sudden, you are 100% invested. So once you're 100% vested, then all of the company's contributions made to your 401k are yours. So that means that you could leave that company and not risk any of your vested portion of your 401k. So it's always ideal to stay until you're fully vested. It's not always possible. I get that. It's not always able to do that. But that is a very, very, very important tip as well, because you can really lose out on a lot of that quote unquote free money that the company is giving you for participating in that defined contribution plan. So let's just review real quickly what we had talked about today on 7 ways to grow your 401k. Number 1, contribute up to your company's match. Number 2, consider the Roth version of the 401k. Find out if your company offers it. If they don't, talk to other people. I would strongly suggest you to talk to other people within your company and say, hey, we really need a Roth version of the 401k if we can get it. And, maybe you can be a squeaky wheel about that at work, because it's really important. It can make a huge difference for you over time of having that 401k operate in a tax-free way when it comes to withdrawals and retirement. Number 3 was to ask about the brokerage link. I had mentioned that. Very, very important. Number 4, focus on high-quality yielding companies, right? Don't use penny stocks in your 401k. Focus on high quality yielding companies, and you will find that over time, that is going to really pay off in the end. Number 5, have a cash strategy, both in the 401k and outside the 401k. We talked about that. Number 6, consider trading as a way to boost your overall returns in your 401k, but obviously do that very carefully and with a very prudent allocation. We suggested, maybe 10% trading and 90% long-term investments. And then number 7, remember, if you can, stay until you're vested. These are 7 tips for you with your 401k to help you grow and boost your savings in these plans. I sure hope this has been helpful. All right, so here in segment 1, we've been talking about the accumulation of assets within your 401k, that accumulation phase as you're working and building your 401k. But what about when you get to the distribution phase? What about when you get to the place where you're ready to take money out of the 401k? Well, we have some very useful information for you on the other side of this break. I'm going to be joined by Mike Mitchell. He's a longtime financial advisor. He'll be here to share a very tax-savvy retirement withdrawal strategy for volatile markets. You won't want to miss it. Hang tight, and we'll see you on the other side.
Show me the money.
Show me the money. I can use money.
More great tips, tools, and advice coming up on Follow the Money Weekly.
Welcome back to Follow the Money Radio, friends. Great to have you here. And as usual, we're joined by one of our good friends and a longtime financial advisor, Mike Mitchell. Mike, it's great to have you on the podcast today. Thanks for joining us.
Good to be here, Jerry. Excellent.
And right now, especially in the world of finance, many people are just, having a tough time. I mean, I got to say, you've been doing this for quite a long time. We have a question I want to talk about, but I got to say, these are unusual times with the inflation fears, but then also the war that's going on. And then we also have all of this money printing that we've experienced. It's enough to confuse a financial advisor, let alone somebody who doesn't know anything about finance. What a wild time this is.
It really is. We get lots and lots of people who are searching for answers every day. Mm-hmm. And they're concerned and somewhat anxious. But they're looking for guidance. They're looking for answers, and we're doing our best to give that to them.
Yeah. And well, speaking of answers and questions, we have a question from Sandy G, who writes in from Cedar Rapids, Iowa. And I want to address Sandy's question. And I get your take on it. I think Sandy is probably dealing with something that many people are dealing with right now. Here's the question. I appreciate your helpful videos, and I have a question regarding this year's market volatility. My income consists of SSI, I guess Social Security, an IRA, and 401k. So it sounds like 3 income streams there. Mm-hmm. My advisor recommends a 4% maximum withdrawal each year from the IRA and 401k. Due to the market sell-off, my 4% distribution this year is considerably lower than it has been in recent years. I already took the normal 4%. And I am thinking about taking a little more later this year, but I don't want to cannibalize my account with the markets trading near their recent lows. I need help protecting my annual income level despite market volatility. What am I missing? Any ideas? Sandy G from Cedar Rapids, Iowa. So Mike, I mean, you have somebody here who is clearly playing by the rules. They have an IRA. They have a 401k. They did good getting those things. They have Social Security income. They're clearly already past the accumulation phase. Now they're in that place where they're receiving income from their assets, and they're playing by the rules, that old Monte Carlo simulation of the 4% that's supposed to work out over time. Well, this year, that 4% was a lot different than it was, say, last year or the year before. So you can understand Sandy's wondering, what am I supposed to do? Am I supposed to take more money out of my account this year? Or as she puts it, it will cannibalize my account potentially. What's the solution here for people who are seeing this market volatility really do a number on their income because they're taking an income from these assets? What's a right way to think about this?
Yeah, we get this an awful lot. We have clients that are calling in with not only the concern about the income going down, but also their accounts are being impacted by the volatility. The accounts are going down. And on top of that, it's almost like doubling down. They're taking a systematic withdrawal from these accounts when it's probably they're the most vulnerable because they've just taken a huge hit. They've just now taken more money out of that account. And now it's going to be much more difficult for the market to recover those account balances and get those income levels back up to where they would like to be. We call this in our practice a sequence of return risk scenario. And there are absolutely some very smart strategies for mitigating this issue. And one of the ways that we do this is we help our clients set up an alternate income source that they can pull from in the event or at the time where the markets may be down significantly. So rather than continuing, as she put it, to cannibalize the account, we actually go to this alternative source of revenue or income, and we bring this from life insurance contracts. We set up life insurance contracts that have cash values in them. Those cash values can be accessed according to 7702, the Internal Revenue Code 7702. They can actually take tax-free policy loans from these cash values, and rather than pull the money from their depleting investment account or portfolio when the market is at a low ebb or a low area where there's been some corrections, they take these incomes tax-free from the life insurance accounts. This in turn gives their account balances in their investment portfolios, whether it's a 401k, an IRA, or whatever. It gives those accounts an opportunity to recover in the market rather than continuing to pull those account balances down even further. So sequence of return defense strategies is the term that we use. And it works exceptionally well because you have an alternative source of revenue to go to in those times when you really need to protect those investment assets.
It's these multiple streams of income. It's
Right.
it's having an alternative strategy that Mike is talking about. So, yeah, it is tough. You would imagine that somebody has built up a nice nest egg, maybe in an IRA or a 401k, as the case with Sandy has both. And you take your 4% out, and if that 4% per year, and that's the rule of thumb stock advisors especially will tell their clients, just take out 4% and that should last you. But again, like Sandy's pointing out, this is not enough this year. And so what am I going to do? Do I cannibalize the account? And as you're pointing out, having an alternative strategy for these types of environments, for this type of volatility, is really powerful. So let's talk just real briefly about what that would look. Is it too late for someone like Sandy to set this up? Is this just something is there anything that Sandy can do now, or?
No.
Okay.
Obviously, if we're talking about life insurance contracts, then health certainly plays a part in that. But a lot of people these days are under the impression that, if they get over a certain age, then life insurance is just out of the question. It's not. Provided their health is good enough to qualify for a life insurance contract, then it doesn't take very long to set up these alternative sources, revenue pools of accessible cash, which, as I said, is also, you can access it on a tax-free basis.
Huge.
It doesn't take that long to achieve some of those revenue pools, to build them to a place where they can do you some good when you need them to do the good the most. And that's obviously when we're in an environment like we are today, which, there's tremendous market volatility going on, and you just need the help in that time.
So true. So having another bucket of money. And by the way, with this tax-free loan provision you're talking about with life insurance, you don't have to take the loan. You don't have to take the money. Maybe you have a great year in the market and you take out your 4% out of the market and it's more than enough and you've got your Social Security check and you're happy. But that year that has a real big decline, like we've seen in 2022, a pretty big down year, this would be a perfect time for Sandy to be able to go and just say, I'm going to leave my stocks alone this year.
Right.
And I'm going to go pull that money tax-free out of this other asset that I have. And then when the market kind of gets back to normal, maybe next year I'll do that. And that option, so many people don't have that, Mike. This is the difference between planning and not planning, isn't it?
Yes,
you have many clients today, Mike, who have this strategy available to them, don't they?
They do. Yes. And having options when it comes to not only money in general, but particularly money in a volatile market environment. And let's face it, there could be some volatility in our tax code coming down the pike in a few years. So, having another source of income that you could rely on that would be tax-free would even be an additional beneficial option to be able to rely on.
Powerful stuff. So if you're listening today, this describes you. This is something that you say, gosh, I need to do a bit more planning here because I'm in that situation that Sandy's and I'm taking money from my accounts and they're at recent lows and I'm having to take more than I want to. There's another way. There's another way that you can do. There's another strategy that Mike's talking about. Mike, if folks want to talk to you about that strategy, maybe they have questions about it, let us know how they can get in touch with you.
Yeah, we have a toll-free number, and the number is 833-370-0777. And they can call that number and leave a contact information or ask us a question, and we will be getting back with them quickly to help them find some answers.
Fantastic. Well, I know we'll have you back soon on the podcast. I know a lot of questions we've been getting too, Mike, maybe just a tease for the next time is we've been getting a lot of questions right now, especially with the market the way that it is, people saying, where do you put your safe money? The money that you don't want to lose, but you also need access to, where do you put it? And so maybe we'll hit that next time and talk about safe money areas for folks. But this is really fantastic. So a really cool strategy today for those of you who are concerned about market volatility and you don't want to cannibalize those qualified plans that you've worked so hard to build up. This is a really great strategy. Thank you, Mike. If folks want to learn more about that, they can reach out to you, and we'll look forward to seeing you next time. God bless, my
Thanks,
friend.
Jerry. Enjoyed it.
All right, friends. Well, I hope you've enjoyed today's podcast. It's been an absolute joy to be here with you and to discuss the 401k and ways that you can boost your 401k as you head into your retirement. And as always, I like to leave you with a final word on each of these episodes. This time, it's taken from the late, great Earl Nightingale, who wrote, "As in all successful ventures, the foundation of a good retirement is planning." Mr. Nightingale's quote reminds me of another quote by Edmund Burke, who said, "If we command our wealth, we shall be rich and free. But if our wealth commands us, we are poor indeed." The point here is to master your money instead of letting it master you, because money is a wonderful servant, but it makes a terrible master. If you need a helping hand in creating a solid foundation for your retirement years, take action by seeking out wise counsel. Don't try to do everything on your own. Surround yourself with wise counselors, and your plans can succeed. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.